Well, this week is what traders have started calling a G7 Super Week, a rare alignment of monetary policy decisions from the Fed, the ECB, the Bank of Japan, the Bank of Canada, and the Bank of England, all landing inside of 72 hours. And Roland Lim gives us the lowdown on what the markets are expecting.
The takeaway is simple. Rates will be kept on hold. That's what the markets are expecting. But the reason is more complicated. Central banks are increasingly caught between two risks: slowing growth on one side and a renewed inflation threat on the other, driven largely by rising energy prices, this time linked to geopolitical tensions and disruptions to key shipping routes. The result is a posture we can call hawkish caution, holding rates steady today, but keeping the door firmly open to tightening tomorrow. Now, this week is about reading which door each bank is leaning toward. We start in Tokyo on Tuesday. The Bank of Japan expected to hold rates, but it is the week's most closely watched wild card. The BOJ is the only central bank in this group that is actively tightening. Bank Governor Kazuo Ueda hiked rates to 0.75% in December. That's the highest rate Japan has seen since 1995, and the normalization path remains open. The question this week is not whether Japan will move, but when the next steps comes. Any signal that it is imminent could trigger sharp moves in the yen and rattle bond markets from London to New York. Now, Wednesday is the heavyweight. The Federal Open Market Committee meets in Washington. The Fed is widely expected to keep its target range unchanged, but Chair Jerome Powell faces a familiar tension: inflation risks versus slowing growth. It's also his last Fed decision before he steps down on May 15th. Markets will be parsing every syllable of his press conference for clues in June. Any suggestion that the bar for cutting is rising, not falling, could reprice equities fast.
Even were the crisis to end entirely tomorrow, there would still be a moderate inflationary impact and clearly subsequently a growth impact as well. These are the second round or the second order effects of this crisis, and that has to be reflected in monetary policy. So whilst I think the de-escalation thesis will probably hold true, and it's certainly part of the Lombard-Odier base case, actually, we don't think that the Fed will cut rates until December this year by 25 basis points.
Meanwhile, in Ottawa, the Bank of Canada is also expected to hold, but the focus shifts to forward guidance. Now, Canada's economy has shown cracks, but energy-linked inflation keeps the BOC cautious about easing too early. Now, Thursday brings the week's most anticipated press conference. The European Central Bank is expected to hold rates, but all eyes and ears are on President Christine Lagarde. Now, her tone on future hikes will set the direction for the euro and European sovereign debt markets heading into summer. If she sounds more hawkish than expected, watch Italian and Spanish bond spreads widen. Now, if she opens a window to cuts, expect a euro sell-off. And just hours later, the Bank of England in London announces its own decision. The BOE is holding, but the UK faces what analysts are calling an inflation shock. Persistent services inflation, tight labour markets, and energy costs refusing to fall. So what does all this mean for investors? Well, three things to watch out for. First, it's the language, not the rates. With holds priced in everywhere, it is the forward guidance that'll move markets. Listen for how many times policymakers use the word vigilant. Second, Tokyo is the swing factor. Any signal this week that the next hike is closer than markets expect could send shockwaves through carry trades globally, hitting emerging market currencies and US Treasuries. Third, if 5 major central banks collectively signal that rate cuts are further away than hoped, well, investors may need to rethink one of the biggest assumptions of the past year, that rate cuts are just around the corner. For CNA Explains, I'm Roland Lim.